40, 50-year amortizations. Yes, that's what we talk about with our good friend Dion Begg. This video is a little off the record, off the cuff, and we cover many things like our latest interest rate announcement and hike from the Bank of Canada. Kind of surprising to a lot of people. So let's get into it. Okay, my friends, today is a little off the record, if you will, with my good friend and mortgage broker Dion Begg. He just mentioned, some of the best stuff that we talk about is the unrecorded stuff. So hit record now, Gare. So we did. So there you have it, my man. What's going on?
Well, as I said to you, it's on every headline around Canada today, which is the, I guess, somewhat unexpected 0.25% increase of the Bank of Canada yesterday. Some didn't expect it. I think 3 weeks ago, if you ask most people, is this going to happen? The answer was probably not. In the last 3 weeks, some market data came out that sort of led other people to believe, okay, there was a chance. And so before yesterday's rate hike, my thoughts were if they didn't raise it yesterday, they would raise it next month, and it just comes down to job data, GDP growth, consumer spending, right? So yeah, they're the things that led to yesterday's increase.
Yeah, yeah. And for those that have been following along, we do a weekly recording with Dion, and just to get the mortgage update and what's going on, what he's seeing. He'll bring us deals from time to time on how to analyze and how to look at deals, the good versus the bad, or sometimes the reality versus the reality. And today's conversation is that it's going to be more of a conversation. Dion and I might just kind of roll with it a little bit, but that's the real, when two friends pick up the phone and talk, that's what happens, right? And the most important thing too is, sometimes the best conversation is just, being that fly on the wall between a conversation, right, Dion? And maybe you're the fly on, not you, but the listener or the watcher is the fly on the wall today. Yeah, there's a lot of interesting stuff, and I know when Dion and I just first jumped on, I said, "So what's new?" And that was his response. Well, and that's just it. So I don't know about you. I haven't. It's been 24 hours ish now since the announcement, and some, like you said, saw it coming. Some, economists or armchair economists wanted it to happen just based on their weird, skewed view of the world, we'll call it. But are you starting to receive some inquiries from the your clients that you're already in conversation with?
Yeah, exactly. So in the lead up to yesterday's announcement, many of our clients, we touch base with our clients who are in particular pre-approved. These are people who are out there looking to purchase, right? And some of them have locked in rates. Some of them, depending on their situation, have not locked in rates, but we're in conversation. And they're the people that I think are probably the most important to talk to at times like this to figure out what's going on in the mind of buyers, right? So in the conversations that we've had yesterday after the announcement and in the days leading up to the potential increase, we spoke with our clients and said, look, how will this potentially impact your decision to move forward, right? And the thing is, Gary, if we go back over the last year, buyers have been on quite a journey in terms of a financial journey, but also psychological. Because what happened last year with the Bank of Canada increasing interest rates was their intention was to force the Canadian consumer to reconsider, in particular, large purchases, right? And a month passed, interest rates went up again. A month passed, interest rates went up again. And in talking with my clients, it felt like they were trying to make decisions with the Bank of Canada just kind of pulling the rug from under their feet. And their mindset moved forward, like, okay, we're going to do it now. And then the rug got pulled again. And that happened multiple times. I think it was 8 times in the last 12 months where this happened. And so many people went through that process last year. Now, we had a 3-month pause, these last three or so months pause, where the Canadian consumer said, okay, well, now the rug hasn't been pulled, and now we're going to move forward, right? And they had to readjust their numbers to the new market. Whereas, January last year was the payment was going to be, let's call it $2,000 a month, and now this year it's $3,000 or $2,500 a month, right? Depending on the rate they got. And so they had calibrated for that extra $500 a month, right? And I think I saw your video yesterday where you mentioned, for every 100 grand, it's going to cost us about an extra $16 a month. Let's put that into context. So let's say on a $500,000 of borrowing, that's now an extra $80 a month, right? So think about this. If you have been waiting to purchase since last year, this is the year you're going to do it, right? You've adjusted to maybe a $500 jump mentally. Is that extra 80 going to stop you? And the thing is, the clients that we've been speaking with, they're like, oh no, we're good. Like we're continuing. We've got momentum. We are not stopping. We know that prices, in fact, have increased significantly, and we should talk about those numbers since January. And so, whatever happens, we've made the decision. We're moving forward. An extra $80, $100 a month. It's a drop in the bucket, mentally, versus the mental jump they had to make last year.
Yeah. I two things I take away from that. Thanks for watching my video from yesterday. and but I love that you just kind of peeled that onion away. That extra $80 on that $500,000 mortgage. The mindset is no, we're good. We've already built that in. That's
Yeah,
interesting. I wouldn't have known that to be true in a sense. We always hear, oh, now buyers are getting scared. They're walking away. When you have a confused buyer or a confused person, you intend to do nothing. And in fact, I'm going to share my screen. We're going to go back to that report. No, we're not. What do I need to do here? Hang on a second. I'll fix this. There we go. Here we go. This is the best part of doing stuff on the fly. I shared this slide yesterday, and
that's it.
Dion, if you look here, we sold 10,000 properties in the month of May on the entire Toronto Real Estate Board. Well, that's a 20% increase from last year's May.
Right.
So to your point earlier, along the lines of the Bank of Canada is increasing rates, so people have perhaps that second thought, or they think twice about their large purchases. Well, we're trending back up. Now, May's always a strong month, but look at the previous year.
Yeah. I would also dare say, Gary, that last year, and I don't know what the previous years were before 2022,
It's right
but
there. It's right there. So there's
totally
2021 and I always say throw
oh,
2020 out.
2020
That's
is just, yeah,
that's
look,
not fair.
2020 was, we're in the middle of COVID. What's going to happen to the world?
Yeah.
2021, well, it was the craziest year in GTA and Canadian real estate that I think ever on record, right? So I think it's almost like we'd have to jump back to the 5 years previous to
Yeah.
really figure out what is normal for May. But what I want to say about last year, May, is interest rates increased in February, March of last year, right? And so that might have been the time when people did sort of decide not to make purchases. The last year's number in 2022 may, in fact, be lower than normal because it was the first real shock to the Canadian economy with interest rate increases in the months prior.
That's a fair point. And you might ask, well, Garrett, how many properties should be selling in the month of May, just as Dion said? And if we kind of April, May, June, if we're hitting that 10,000 properties a month, that's a good number. That's a fair number. It's not over the top. It's not underperforming. Into the summer months, I mentioned yesterday, it'll probably tail down to about the 9,000, maybe slightly low, but that's typical. That's the market cycle of the year. We have sold in the past, Dion, and you know this. We have sold in the past as many as 120,000 properties on the Toronto Real Estate Board in a year, and as the
Bumper year.
kids say, that's a banger year.
Yeah.
We're probably going to be in along the lines of about 80,000, 75 to 80,000. I'm seeing, even though people are saying we're dropping, we'll probably end up at around that number. I think a healthy number is 100,000, but we're not going to see that this year. A healthy number for the economy is probably 100,000 in all reality, and that just
Yeah.
helps everything, right?
Sure. I mean, there will be people who, as of yesterday's rate announcement, decide, okay, we were going to go back in, but we're not. Earlier when I was talking about our clients who are pretty much pre-approved. They're doing paperwork. They're moving forward, right? But there may be some people who I haven't spoken to who are maybe gonna call us or call you next month and now say, you know what, no, we're going to wait. But the question is, what what does waiting do? What will it do? And nobody really knows, right? And so let's take a look. The number that's ringing in my mind is the number I saw for on the Toronto Regional Real Estate Board statistics from January this year to May this year. And the simple one is the single detached. Did you see these numbers, Gary? Because these numbers are like emblazoned in my memory now as of
I
reading.
I gotta say yes, but I want to say no because you've got them right here, and you're gonna put me on the spot, and I'm not ready for that.
Okay, so let's just think about the journey that pricing went on. February, March last year, we had an absolute peak in Toronto and GTA real estate pricing. A detached home in Toronto was at $2.1 million. Okay. This year, January, that same property or that average was at 1.4 million, a huge drop.
Mm-hmm.
In May, it was at 1.6, sorry, 1.9, 1.9 million.
Wow.
That's a 28% recovery on that low price point and a smidge below the absolute craziness that was the pricing in February and March last year. So I was just actually having a coffee with my wife yesterday talking about these numbers. And in the stock market, they talk about these price points of resistance and support. And so, if anybody wanted to know what was the price point support, the low point below which the market would likely not allow properties to drop below in Toronto, well, I think that number came to us in January, and that number was 1.4 million, right?
Mm.
And moving forward, I think everybody can sort of take heart from the idea that okay, the property prices in Toronto are never going to drop below that number. And in my humble opinion, I don't think we're going to get anywhere near that number, regardless of what might happen this year. There is talk of potential interest rate increase, but to recover from 28% in 5 months, from 1.4 million to 1.9 million, I don't think anybody could have predicted that this year.
No, not at all. Well, hence the interest rate hike, right?
Well,
I
again,
mean
that's
that
part of
right there, and there's other things to it, and I know one of the things that I mentioned yesterday, and this still always blows my mind. Where interest rate is a tool to fight, or fight's a terrible word, to balance. How about that? To balance out inflation,
it. And
and one,
it's the bluntest tool there is
yeah.
because it doesn't target particular segments. It impacts anybody who has debt, homeowners and business owners, right?
Yeah, business owners especially, and that's that ripple effect that we don't often think about, right? Is now all of a sudden, and a lot of businesses will operate. They'll use lines of credits as their operating capital and so forth. And sometimes we just don't put that into perspective of what that means when you have a variable rate that fluctuates on that. Because obviously, you have a good performing business, you're going to do well. But on the flip side, there's many small businesses that rely on that line of credit to buy product before they can sell it and things like that. It's just the nature of how business is done. It,
Correct.
there's, there's
Let's be clear here, though. With the interest rate increase, the government knows. They know who they're going to impact. It's homeowners, it's business owners, and again, it sounds kind of crazy, but the government is hoping for unemployment. They're hoping
yes,
for people to be hurt. Okay, and the challenge around the interest rate increases that we've had is that right now, companies have not had mass layoffs. Like when not, it doesn't take 50% of the population to be laid off for people to start making decisions about spending less, right? It takes a very small percentage, but it has to happen to the point that you and I both know somebody who was recently laid off.
yeah,
Because what happens at the weekend barbecue that you go into on Saturday and Sunday is you get together with your friends and you say, "Hey, did you hear Jim just got laid off?" Right? And when people start thinking about that, what happens in their brain? They say, "Oh, well, maybe I'm next."
that's
And
right.
as they might start to spend a little bit differently. That's actually what the government wants people to do right now,
Yeah,
and they're not doing it.
yeah,
Right?
and it will happen. The crazy thing is, I'm sure you can go into any mall or local plaza. They have the help wanted signs up and things like that. So when we see that, we think, oh, the economy is doing well because that's for some silly reason that's our that's what's the word I'm trying to say? That's how we view the economy. Well, if my local Tim Hortons and the local, shoe store in the mall is looking or they're looking for employees, then we must be doing okay. Well,
Yeah, I mean that
that's
makes
not
sense.
a that's not really a fair representation of the economy, but that's just people's mindset. So I just looked it up. We're sitting right as of April. We're sitting right now at about 5.4% unemployment rate. We probably need that to go up to about 7% to really swing something. Would be my guess, but we'll see what happens there. And that is that weird tool or ripple effect of what happens with inflation. And neither are I. Well, I'm not a huge economist from that perspective, but as I learn more about economy and things like that, I know that that's a
Sure.
factor into
Yeah,
it.
and
But
I heard a recent interview where I think it was an economist said, what's happened in Canada is that a lot of people have felt a little bit of pain. But what really needs to happen is a small amount of people need to feel a lot of pain,
mm,
which is unemployment and therefore inability to make debt payments. And when that happens, the idea that that could potentially happen to the remainder of the population is enough to cause them to spend differently, right? So it's a pretty dire conversation when you think about it. It's like, oh wow, yeah, we need to cause pain to a small segment of people. We
yeah,
need people to become unemployed. But and you know what's delayed this a little bit, and the fact that consumer spending is there, is that when people are currently going through challenging times with their mortgage payments, historically they would have to restructure, they would have to break their mortgage, get a second mortgage, whatever the case may be. But across the board, most Canadian financial institutions now, when they have a client who's struggling, are automatically allowing them to stretch out the amortization on their payments to 30. And maybe you're on a 20-year payment and you call up the bank and they'll say, no worries, we'll put you on a 30-year. And some institutions are pushing them even out to a 40-year. And so while there is pain, that pain isn't felt in cash flow immediately. It's felt in extended amortizations, which means you're in debt to the bank for an extra decade, right?
yeah,
It's delayed pain, which people don't feel right now. And so they're not changing consumer spending patterns as far as I can see.
yeah. It's such a weird anomaly that I don't know if the Bank of Canada and the Brain Trust there saw that happening. Um,
Yeah, it's outside of the scope of. I'm not in those rooms. I'm not on the fly. I'm not the fly on the wall
yeah,
of those discussions. But you know, did the government expect banks to not change lending criteria and not be as lenient? And therefore, did they expect banks to just sort of say, well, no, if you can't make your payments, there's only so much we can do. So now you've got to give us back the property, right?
yeah,
And move on if you can't make these payments. That didn't happen, right? And maybe when all this stuff went down last year, somebody at the government should have spoken to all the banks and said, listen, here's the rules.
yeah.
We're doing this. It's kind of like filling a bucket and with a hole in it, right? And the bank is making the hole so that you can keep filling the bucket, right?
That's
Whereas
right.
if the bucket was plugged, it'd overflow and we'd actually have the problem that the government was trying to create. Again, I'm not privy to those conversations, but it's clear the government's acting in one way and the financial institutions are not bending over backwards to help them achieve that goal.
Yeah, yeah. It's well, what I like about it in a sense is it's the banks not being so rigid. It's thinking a little bit creatively or outside the box or here's the box and someone was smart enough in one of those boardroom conversations to say, well, what if we just allow people to reamortize or extend their mortgage in layman's terms, which, you know, it is a strange anomaly, and you and I have talked in the past. If that wasn't an option for many people that are on the variable rate, let's be real. It's not people that are on a fixed rate. It's the variable rate mortgage holders.
Yeah, and to be clear, it's the variable rates with variable payments. because
Yes.
most
Yeah.
banks don't have variable payments, right? And so it's the ones who've been feeling it in that regard. But also, it's the people who are up for renewal. Okay, so here's an example: you signed up for a 25-year mortgage. You're at your renewal 5 years later. Your schedule says you are on for an extra 20 years, right? So you paid it down, you 20 years left, and people are just flipping that back out to the 30 years.
Yeah.
Those people who can, right? But yeah, this is yeah, the things that are going on behind the scenes are things that I never thought we'd see. Like when I got a couple of months ago, when I got a statement from my client that said, "Yeah, my bank has offered me a 40-year amortization." I had to make some phone calls and say, "Is this real? Like this is Canada. This I haven't seen a 40-year amortization in Canada. I think they didn't have them until since the early 2000s."
Yeah, there was a short period where they allowed that, right? 0% down and up to 40 years or something like that. But yeah, that's very, and this is not something new to the banking world. This is something that happens in many European countries as well because of how highly priced real estate is there. So it's not like we thought of something new. We just, borrowed another idea in a sense. Yeah, it's definitely interesting that in what that does to the length of how long you choose to stay in that particular home, um, all of those things. So maybe that slows the market down from that perspective, or the cycle of your market. So here's the thing, and you and I know this very well. Most families will have 3 to 4 homes in their lifetime. Some have more, right? You have your first time home buyers in it for 3 to 5 years. They grow out of it. They start a family. Then you move into your next. And sometimes there's 2 homes before you move into that kind of that last retirement home in a sense, right? So
Yep.
will we see that cycle stretched out, or will we see that cycle get compacted a little bit? Or maybe Dion, I don't know. This is off the record, right? Maybe we see some of those purchases being skipped. They go right, instead of the first time home buyer, they go right to the bigger home that has multi generational living opportunities. Right? What do you think?
Yeah, I think. Well, I mean, look, transactional costs have gone up and up with with moving. So if you don't have to spend $100,000 when you move on land transfer tax and other things, then I have seen people make the decision to stay in the home that they are in, right? And with what we discussed just a couple of weeks ago, with the ability to now take any single family home and convert it into a multifamily up to a 4 unit in Toronto, then yeah, this may be something where people choose to stay in that home. And I'm sure that when you were growing up, and maybe the generation before more so, there were those intergenerational homes which were passed down from parents to child and so on and so on. It happens. It still happens in a very big way with cottages in
Yeah.
Canada, right? But with the principal residence, the home that you grew up in, would that be transitioned to you and as the older people who, your parents or whomever, move on to their next destination? That may be something that becomes a more realistic thing now. And earlier when you're talking about how long will these amortizations get, I lived in Japan for about 4 years, and when I was there, I can't verify this story, but when I was there, I heard from somebody that there was a time in Japanese banks when you went to sign your loan, you would also take your child, and your child would sign that loan as well, because it was an intergenerational mortgage, right? And
Interesting.
as much as we laugh about this, and again, I read a headline not too long ago, the United Kingdom has recently come out and or proposed a 50-year amortization, right? So that is
Interesting.
actually on the cards. Now, you know what? Those we have 40-year amortizations existing on CMHC multiplex properties here in Canada, right? And to jump from 25 to 30, and now from 30 to 40, it may not be that far of a stretch of the imagination.
Yeah. Yeah. And you might think, well, how will I ever pay that off? Uh, Talk to Dion. There's ways we can do it through different investing strategies and understanding the market that you're in, and where you want to live, and where you should be buying and so forth. Because you and I both have worked with many people in the past. I want to live in Toronto because it's close to my office, but I certainly can't afford. Well, then perhaps we look at a secondary, tertiary market where you can afford, where it becomes an investment property. So you're building that wealth for
Yeah,
the future. So
100%. In fact, and I should mention this, so I forgot to get the link, but I'm presenting a webinar on this topic, which will cover how are people buying, what are they buying, are they working together with family. That next webinar is coming up on June 20th. That's a Tuesday at 7 p.m. I'll give you the link, Gary. You can drop it in the comments, and then people can register if they wish.
yeah, yeah, and that's such a tremendous opportunity to learn. It's always important to educate yourself, especially during these times where there is some uncertainty or confusion, and that you've got to set your family up for the future. Maybe you have children going to school soon, or you're looking to wind down your working life, and what does that look like, because you still want to provide for your children and help them purchase a home. That's a big piece that we're seeing right now is people are passing on and using some of the equity that they currently have in their home to help their children buy. And I know you're going to touch on some of those topics,
Yeah,
which
100%. And it kind
yeah,
of links with what we just said. Like that's an unofficial intergenerational mortgage, right? Mom and
yes,
dad are
yeah,
giving
of course,
100 grand from their mortgage to their children, but it's still a mortgage that's paid for by the family to assist the children. So while it may not structurally be a property, it's money that's spread across two properties, you know. So I guess we do have intergenerational mortgages if we look at it that way. That's if you were to count the last 10 first-time home buyers who you helped, Gary, right?
yeah.
How many of them? How many of them got help from family?
I think 9 out of 10.
And we see the exact same
Yeah,
numbers, right?
yeah.
So these first time home buyers are definitely needing assistance from family. So intergenerational mortgages exist off the record, I guess, right now.
That's right. And as I think about it, uh, I'd say half of them, at least half of them, purchased an investment property that they could start building equity in, as opposed to, hey, this is my primary residence. Yeah, yeah, interesting as I kind of peel that onion away. Good stuff. All right, my friend, this has been fun. I like that it was kind of off the record, off the cuff, but all important stuff. Do reach out to Dion and get connected with that webinar and educate yourself, because there's many people in the same situation that you are, and you need to have all the information that you can, so you can make wise choices. Dion, how do people get a hold of you?
Yeah, mortgagesbydion.com. Find me there, and look forward to talking to anybody who has those questions and or wants to attend that upcoming webinar that is for first-time home buyers and investors.
There you have it, my friend. So, of course, that's Dion Begg over there somewhere. And I'm Gary McGowan. We'll see everybody in the next video. Goodbye for now.